Download our complimentary guidebooks, checklists, and other useful financial resources at savantwealth.com/guides.
Welcome to today's Savant Live webinar. Thank you so much for joining us. Today, we will be discussing gifting to family and how to minimize Uncle Sam's cut. My name is Elena Davalos, and I'm a wealth transfer advisor here at Savant Wealth Management. Joining me is our private client group leader, Jonathan Milligan.
Thanks, Elena. Happy to be here. I think this is one of my favorite topics to talk about with individuals. I think it's always so rewarding when you talk to someone that has been successful, have accumulated enough wealth that they can begin thinking about being generous, transferring that wealth to family or to friends. So I'm looking forward to our topic today.
Great. I think it will be really beneficial for all of our listeners today. Some of the themes that we'll be talking about today are going to include how gift taxes work, when those taxes are applicable, and what tax rates also look like. We'll also be discussing the concept of gifting with warm hands versus cold hands. Generally, you gift with warm hands when you're with us and cold hands when you're, well, not with us anymore. So, this concept is the difference in making gifts during your lifetime, allowing you to see the impact and share in the enjoyment of that gift versus passing wealth to your family or other beneficiaries at your death. We'll also be discussing who to gift to. Every gift has a giver and a recipient. Today, we will focus on when individuals, like family, are the best recipients as opposed to charitable organizations. The good news is if you are curious about passing wealth to future generations at your death or giving to charitable organizations you're passionate about, we do have resources to help answer your questions. So while we won't be able to answer everyone's questions live today, please feel free to leave a question in the Q&A box at the bottom of your screen and we'll be in touch with you. You can also visit our Savant YouTube page where you'll see past webinars on this topic or reach out to our team and we can connect you with some additional information.
Thanks, Elena. Let's talk some now about the agenda for today. So there's a few important markers that Elena and I want to hit during our time. The first of those is something I call the 3 Ps: priorities, pitfalls, and purpose. So we'll talk through that, followed by Elena covering some important tax law and rules around the gifting. And then we'll move on to tools or different assets that you may be considering using as part of your gifting plan. And then lastly, we will talk about strategies. What better way to do that than with some real world case studies? So with that, let's jump in. I mentioned the 3 Ps, and that's where we're going to start. So I'll give you another P, a bonus P, if you will, to begin with, and that's preparation. All of these items really fall in the category of things you want to consider before you begin making gifts to your family or possibly friends. So with priorities, you've heard the phrase on an airplane that the flight attendant always says, if the oxygen mask dropped from the ceiling, you need to place your own mask on first before you help others. Well, I want you to think about that phrase as we're also thinking about gifting, because we want you to feel really comfortable with your own financial footing, your own financial future before we begin thinking about making gifts to others. So the priority in this case is yourself, and it's okay to be selfish in that regard. I think a few things to think about as you are kind of in this bit of a selfish mode here in the beginning is, do you have sufficient wealth to live on for the rest of your life? Of course, we want to make sure we're well taken care of before we begin thinking about transferring wealth on to someone else. And then as you're doing that, think about not just yourself today, but also future you, right? Because situations may change. You could become a widow or a widower. You could have a change in your income, any number of things that could happen in the future that may impact your financial situation. And I can't encourage you enough, if you are not sure about those items, if you want to have a discussion, reach out to someone, reach out to an advisor, a wealth advisor like we here at Savant, maybe an accountant or an attorney. I think the more advisors, the more people you have to offer some insight, the more confidence you will have. So let's talk about pitfalls. And we are going to talk later about specific pitfalls around some of the gifting strategies that we'll cover. But these pitfalls are really in the category of things you may not think of as you're preparing to make the gift. And so over the years, I have seen a few blind spots with individuals that I've talked with. One of those, as they're thinking about their future, is really a miscalculation on what they will spend in the future. So I think sometimes we believe what we are spending today is what we will always spend. But as you can see in this example, someone that's spending $96,000 a year, $8,000 a month today would see that more than double over the course of 30 years. So as you're thinking about what your needs are today, make sure you're accounting for those future spending increases. The second is your investment rate of return. So we know if we're looking long term that the assets that we have will grow at some level over time. You want to make sure you're using a reasonable return for those investments. I know sometimes we can believe maybe the return we've received in the past year or 3 years or 5 years even is what we can expect to receive in the future, and that's not always the case. Or I've seen some individuals that find an average rate of return through their research online. That can be very tricky. That average rate of return may not be what you experience. So you'll see many wealth advisors and financial planners, investment advisors mention the phrase, past performance is not indicative of future performance, and that is certainly the case. Last is the unknown and unexpected. So I mentioned this earlier. How might a change in your situation impact your financial standing? So think of maybe a loss of pension income, maybe change in Social Security income, maybe a long-term care need. So I think all of these things are something you need to consider. Next, let's talk about purpose. So this is our third P in the 3 Ps that I mentioned. And let me give you a few tips around communicating the purpose of your gift to your recipients. So first is think about, are there any strings attached to this gift? So as you're considering making a gift to a family member or even a friend, is there anything that you want them to use the gift for? Maybe a particular expense. Maybe you expect them to save the gift. Whatever the case is, I always use the phrase, attempt to over communicate. Whatever the purpose or maybe whatever your intentions are, make sure that's really clear to the recipient before you make the gift so that you are on the same page. Second is, are there any future gifts that you have planned? And it's okay if you are not sure. The message you send may simply be, I'm giving you this gift, recipient, in this year. I hope to be able to make gifts in the future, but I'm not sure if I will. And I don't want you to count on these gifts in the future. Likewise, you may intend to make gifts in the future, and if so, I think communicating those to the recipient can be very helpful from their standpoint as well. And then last is the opportunity, as I'll call it, to pass on not just the financial part of the gift, but also some wisdom and values. Maybe you've got a money story around the reason that you're giving this gift, something that you can transfer on to the recipient so they get not just the benefit of the financial aspect, but also the benefit of that history and maybe some of the values that come with it that you want to communicate as well.
That was great. Thanks, Jonathan. Y'all better watch out for those pitfalls. They are very important, and just, make sure you've got that preparation. So, switching gears, let's take a look at how the law treats lifetime gifting. Jonathan and I regularly meet with and consult clients on the most tax efficient ways to give during life. We tend to hear some of the same misconceptions or misinformation over and over. Before we go into those misconceptions, I do want to make one thing clear. I'll be talking about 2 taxes, income and estate taxes. You people realize that all transfers of money or things are taxable under our current tax laws, but there's usually exemptions or exceptions available that stop actual taxes from being levied. Income taxes, we are all familiar with. It's the personal tax paid on earned income, dividends, things like that. Estate taxes, which are also known as the wealth tax, are the taxes paid when someone passes away and before their estate can be transferred to the intended beneficiaries. That's when those taxes are paid. We don't hear about estate taxes that often, certainly nowhere near as often as income taxes. So, one of the most common misconceptions is that all gifts are taxable, either to the donor or to the recipient, either the person giving or the person receiving. So that is not a cut and dry misconception. The easy half of the answer to this is that the recipient is never taxed. They don't have any income tax liability. They don't have any estate tax liability. There's nothing for them to report on any return. The donor, however, the person giving the gift, is subject to gift taxes depending on the size of the gift. We're going to do a deep dive into that, but let me first say that another misconception that gifts to individuals, such as friends or family, are income tax deductible. That is never the case. There are no income tax benefits, at least on a surface level, to doing lifetime gifting. So if we can switch, let's go and look at how much can you gift without having to file any sort of return. So looking at the donor, the person doing the gifting, how much gift tax is due, and I say that on quotes because it depends on the amount. There's a current annual exclusion amount of $19,000 per person. That means that you can gift up to $19,000 without owing any gift tax or having to do any reporting on that gift. A married couple can do double that gift. Makes sense? There's two people. So a married couple can gift up to 38,000 to anyone without having to notify the IRS. This is the easiest transaction and the most applicable to most Americans. So as you can see on this chart here, the annual exclusion amount has steadily grown since 2011 and has reached that current $19,000 amount. No one knows if this is going to be the amount that's applicable next year, the year after that. It all depends on Congress. So what happens if that amount goes over 19,000? What if you want to do more than that? What we have then is your lifetime exemption amount. And that lifetime exemption amount means you can transfer this much either at death or during lifetime before paying any federal estate taxes. Each American currently has $13.99 million of exemption, meaning they can pass that $13.99 million without having to pay any estate or gift taxes. And this very high bracket is why we don't hear about estate taxes that often, because it doesn't apply to most families. The estate tax exemption has fluctuated throughout history, as you can see here, and it's currently the highest it's ever been. That number is controlled by Congress, so it can change at any time. It's already scheduled to sunset at the end of 2025 with the sunset of the Tax Cuts and Jobs Act, and we imagine it will be down to about $7 million per person. Again, that's how much you're able to pass during lifetime or at death without having to pay any taxes. So sometimes it could be better in your case, depending on your net worth, should we pass up to that $13.99 million now before the sunset decreases or the sunset occurs at the end of 2025. The exemption is a use it or lose it. So once it decreases, you can't get it back, but you won't be punished for using it while it's high. So let's say, for example, you wanted to gift $8 million of your company's stock to your child. If you make this transfer during 2025, you wouldn't owe any gift tax. You also wouldn't be punished when the gift tax sunsets at the end of this year. If you waited to make that transfer and you did it in 2026, the exemption decreases to $7 million per person. you would have to pay estate and gift taxes on the $1 million overage. And my one caveat to this, of course, is that tax law is controlled by Congress, and we do not know currently what Congress is planning on doing with the tax code, whether the sunset will happen or not. So looking next, I want to look at, we also have inheritance taxes as well as estate taxes. And you can see here which states impose estate and inheritance tax. The difference between an estate tax and an inheritance tax is that the estate tax is paid by the estate of the person that died. Assets are only distributed out of the estate after the tax is paid. With an inheritance tax, the beneficiary who receives the inheritance pays the tax personally. And so you'll see here that little bitty Maryland right there does have both. So if you are a Marylander, please discuss this with your advisors ASAP. However, just like the federal estate tax, these states do have varying exemption amounts, but unlike the estate tax, which is flat 40%, many of these states have progressive rates. And one thing that I do want to emphasize is that if your state imposes state estate taxes, that is imposed on top of the federal estate tax. You may get a deduction, but there is a lot of math that goes into it. The other thing too is these states, they may also impose that gift tax. It may not just be a transfer at death that causes tax liability. It may also be this lifetime gifting. So if you're in one of these states on the chart here, you see it's colored in, make sure you ask your advisors whether you would be subject to any state gift tax. Now, let's say you do think that it would be worthwhile to do some lifetime gifting for federal estate tax planning purposes, and you want to go over that $19,000 annual exclusion amount. I want to briefly go over the steps of gifting with you, as well as reiterate the benefits and the risks. So the first step of gifting is to decide if you want the asset to be given outright to the beneficiary or in trust. If you decide to do that in trust, you'll need to first set up the trust. You decide what sort of trust, who the beneficiaries will be, the trustees, things like that. Sign the trust agreement. Next, prepare your assets for the transfer. You may need to get approval or permission from business partners, spouses, things like that. Get your ducks in a row during this time. Third, actually transfer the assets. Sign the deeds, move the accounts, assign the business interest. The day that those documents are signed or that the assets get gifted away is the day that you'll need to provide a valuation for, which is the fourth step. Valuations. Once you have a date and discernibly gifted assets, meaning you know exactly what you've given away, you have to start working on valuations. The IRS requires you to provide something called adequate disclosure. And what that means will depend on the assets itself. How much is the business interest worth? How much were the liquid assets worth? And who is determining that? Lastly, most importantly, you file those trust agreements if they exist. You file the transfer documents, anything related to these transactions with a 709 gift tax return. The gift tax return is due on April 15th, tax day, of the year after the gift is made with your personal income tax return. However, you can file an extension if you file an extension for your personal returns to October 15th. The best advice I will give you is do not wait until September of that following year to try to get valuations and appraisals done. Your valuations people will not be happy. So what happens after you get this 709 in is it starts a 3-year statute of limitations for the IRS to contest the values of the gift that you made. And in exchange for taking these steps, you could use this historically high estate tax exemption. You'll also freeze the value of any growth of those gifted assets, and you may be providing additional creditor protection in the event you're ever sued. So, not to be too cliche though, with great reward comes some risks. First off, please know that this is usually not a cheap endeavor. And if it is, something has gone wrong. You want to make sure you work with an attorney that specializes in this area of law. You will pay for that expertise. Same goes for the CPA who files your return and who you get to appraise your assets. Also, generally speaking, assets that are gifted, again, whether outright or in trust, do not get a step up in basis for income tax purposes, which is why it's important to analyze which assets you're gifting before transferring them to a trust. And lastly, your gift return can get audited. The IRS can come back and challenge the values that you've used. Anytime that you're audited, your legal expenses challenging that challenge can add up.
Thanks, Elena. Let's move now and talk about some tools or some different assets that you may want to consider as part of your gifting plan. So we'll start first with the most straightforward, and that's cash. So everyone understands that, whether you're actually giving someone paper money, or more likely if you're giving a sizable amount, you would be giving a check or even an electronic transfer. Whatever the case is, I think the simplicity of it is really where the benefit is with this. And then also, you want to keep track of how much you are gifting throughout the calendar year. Maybe you're gifting a few $1,000s a few times during the year. You want to make sure that you're keeping track of that so that you have a record of that as you get to the end of the year. Next is a very similar approach, but this time we're giving cash in order to fund savings for the person that you're giving the dollars to. So oftentimes this is an IRA, maybe even a Roth IRA. So you are giving the dollars not just for the recipient to enjoy, but with the intention that they can then take those dollars, contribute it to an IRA or a Roth IRA based on the recipient's financial situation. And then I think the benefit there is it encourages savings, encourages that ability to appreciate the long-term growth of those dollars over time. We do need to keep in mind that there are limitations for how much the recipient can actually contribute to an IRA or a Roth IRA during the year. So the IRS sets that limit throughout the year or at the beginning of the year. And the recipient does need to have sufficient earned income in order to contribute up to that amount. So as an example, maybe you have a grandchild. They have a summer job, they earn $3,000. Even if you gift that grandchild more than $3,000, $3,000 is the most that they would be able to contribute to that IRA. So are some issues there to consider if you are giving those dollars with the intention of the recipient using it for an IRA contribution.
Jonathan, can I ask you,
Sure.
could you transfer that gift directly to that beneficiary's IRA account?
No, in this case, you cannot. So IRA contributions must come directly from the person that's making the contribution. So if you are the donor and you want your recipient to make that contribution, you need to first transfer those dollars to the recipient. Once they hold that in their name in a personal account, maybe it's a checking account, they would then take those dollars and contribute it to the IRA at that point. Great question. So let's move on now to securities. And in this case, I'm talking about stocks or bonds or mutual funds. And the benefit here is there could be an income tax savings by using this approach. The real key here lies in the reminder that you'll see, which is if you are giving an asset like this, you are not only giving the market value of that stock, you are also giving your own cost basis as well. So the recipient receives not just the market value of the stock, they also receive your cost basis. An easy example is you have a stock that is currently worth $200, but that you paid $100 for. When you transfer that, the recipient now has a stock worth $200, but their cost basis is $100. The possible benefit there is if the recipient is in a lower tax bracket and they sell that stock, now they would have a tax liability on the difference in the market value and the basis. $100 in the example, and their tax may be lower than what you would experience if you had sold that stock and instead given the recipient cash. So it's not always the case, but it can be a bit of a tax play there by giving stock. Let's talk about real estate. So we're moving up the complexities scale. Certainly some more things to consider if you're considering giving a piece of real estate. Like our previous example, I think the key thing to keep in mind as you give a piece of real estate to someone, you are giving not only the market value, but the cost basis as well. This can be very important because oftentimes if we leave real estate to someone at our passing, then the recipient receives what's called a step up in cost basis. Their new cost basis is the value of that real estate on the date of your death. By giving them the real estate during your life, they no longer would receive that step up in cost basis because they would have already received your cost basis through the gift. So certainly some forethought needs to be put into this before you think about giving real estate. As Elena mentioned earlier, some assets you may want to consider giving at your death as opposed to during lifetime. And I think real estate could possibly be one of those. Last is loans. This is a strategy or a tool that's not used as often, but can be helpful in some cases in a situation where you do want to give a dollar amount that is higher than that $19,000 annual exclusion that Elena mentioned earlier. This would be one way to do that. So in this case, you would have a formal loan agreement between you and the recipient in which you are stating how much you're loaning them. You also have an interest rate stated. You cannot create your own interest rate. There are guidelines that the IRS issues that you do need to use and incorporate into that loan agreement. And then you may say, well, what is the real benefit of a gift if you're making a loan and then there are loan repayments by the recipient? Well, the key is each year, and typically these are arranged for there may be an annual payment of the interest or an annual loan payment back to you. Each year when that happens, you would simply issue a formal letter that says you are forgiving that amount of the payment. You're forgiving the interest on that loan to the recipient. So no dollars are changing hands from the recipient back to you. Instead, you're forgiving that dollar amount. And then as you do that year to year and over time, that total amount that you have loaned to them ultimately reaches zero. And ultimately you have gifted them that full amount.
So there are, however, a few assets that cannot be gifted. Isn't that right, Jonathan?
That is correct.
So the first one, and usually the most applicable to most people, is a retirement account. So that includes your 401ks, your IRAs, 403bs, any special qualified account that already gave you an income tax benefit during lifetime. Transferring this account to anyone's name other than the original account holder, including a revocable living trust, disqualifies the account and may result in immediate taxation. Please always consult with your advisor before retitling your qualified accounts. The next two types of assets aren't necessarily prohibited from gifting, but you can run into issues that need to be accounted for. So, for starters, some business interests or stock in a closely held business may have contractual prohibitions on transfer. What that means is that the controlling documents of that business may say no, hold on, you cannot transfer this without certain rules being met or to certain people. So, for example, interest in a closely held LLC may prohibit the owner from transferring that business interest to anyone outside of the business. If you have interest in a closely held business like that, before talking about doing any sort of gifting or transferring that interest to a trust or someone else, gifting that asset away, check the operating agreement or bylaws for that business. You want to be clear on what your contractual rights and prohibitions are related to that stock. If you are prohibited from making transfers, see if there's any way you can talk to your business partners, the board of directors, see if they can make an exception for you if you explain those circumstances. Otherwise, you won't be able to make that gift. Another asset that we run into issues with is life insurance. And let me make one thing clear. Life insurance policies can be gifted either during life or at death. Obviously, not any on your life at that point, since, well, they'll be cashing out at them. But many people don't realize that the cash benefit of a life insurance policy is included in your taxable estate for federal estate tax purposes. So, another reminder, this is estate taxable, not income taxable. So, it won't apply to many people because not many people are subject to those estate taxes. And it won't apply to those who receive the death benefit proceeds from the policy. Anywho, getting back to gifting these policies, if you want to transfer the ownership of that policy out of your name to someone else, they can be gifted, but there is one tricky point to keep in mind. Any life insurance policy that is transferred within 3 years of the policyholder's death will be included in their taxable estate. So if I have a policy on my life and I want to transfer it to a trust for my husband's benefit, I can do that, no issues. But I do that in 2020. If I passed away in 2022, the death benefit of that policy is still going to be included in my taxable estate. This is a very nuanced part of planning, but it's something to be conscious of. And again, talk to your advisors about this because death benefits on these policies can be pretty large. And it would not be ideal for them to be subject to estate taxes because of a failure to properly plan. So keep this tidbit in the back of your brain in case it's ever applicable to you. Now, back to those assets that we can gift. What is the best way to do it? Outright or in trust? So, Jonathan might disagree with this statement, but I'm just going to say it. Estate planning is the best tool that you have to preserve your wealth, not just for your children and your grandchildren, but as far down your family tree as your bloodline will go. If it's right for your family and your set of circumstances, an estate plan that establishes trust for your descendants is the best way to preserve generational wealth and to minimize long term estate tax exposure. So, the sort of trust that I'm going to be talking about today is a series of irrevocable trusts referred to as descendants trust or cascading trust. Because once you put assets into the trust, either during lifetime or at death, the assets will stay in trust for cascading generations. So, first to your kids, then your grandkids, and so on. Another term for this sort of planning that you may be more familiar with is a trust fund. These are the sorts of tools, these trust funds that will transfer wealth for many generations. A lot of times, these trusts, I think, get a bad reputation because they're seen as only for really wealthy people or as trying to control assets from the grave. This is a phrase or a worry that I usually try to avoid because it has a pretty negative connotation. No one wants to be labeled as a control freak. But hear me out. If a trust works for your family, you can protect assets for a possible unlimited amount of generations. You protect those assets from divorce, creditors, future estate taxes. How long the trust lasts depends on state law, and it can range from 90 years to an unlimited number of years. And generally, I will say most state trust laws are only getting more and more flexible. So why doesn't everyone do this? Why do we only associate trust funds with the wealthy? That's a question that I get from a lot of clients when we start talking about these descendants trusts. For starters, a trust can be more complicated to both set up and administer. These trusts are often established under a will or revocable living trust. And you will have more decision making that you have to do for those documents. You have to pick a trustee, you have to pick distribution terms for the trust. You have to decide when income and principal can be pushed out. If you're making a simple lifetime gift of $19,000, this administrative burden may be too much. It's not worth that gift. If, though, you're doing substantial estate planning gifting, meaning you're worried about your estate tax exposure, you're worried about creditor exposure, asset protection, things like that, going through these processes can provide significant protections for your wealth down the road. And I don't want to get too bogged down in trust formation because it is an advanced topic in and of itself. But generally, you name that trustee to manage the trust fund on behalf of the beneficiary. You can give your trustee as much or as little guidance, control from the grave, as you feel comfortable with. If you do decide to set up these trusts for your descendants, like I said, they're most oftentimes created under a will or a revocable trust, but you can use them for lifetime giving as well. The difference is that if you set up these trusts during your lifetime, they typically have to be irrevocable, meaning you are not able to change them. So do take that into consideration when you are looking at gifting to a trust as opposed to outright. Are there any special exemptions, Jonathan, you wanted to go over?
Absolutely. The saying is there's always an exception to the rule. And so while these may not exactly be an exception, I think there are some important special treatments that we should talk about with some different strategies. So first, let's talk about 529 plans. 529 plans allow what is called super funding or expediting 5 years of your annual exclusion gift all at one time. So if you wanted to make, for example, a large contribution to a 529 plan for the recipient, then you could do that. And there's, several benefits to 529 plans, depending on your perspective. They actually allow a lot of control by you as the donor if you remain as the owner of that 529 plan. So I think not the least of which is you can actually change the beneficiary of the 529 plan. So you're making a gift to one person now, and in the future, you may decide that that gift really should go to someone else. You would have the ability to do that within the 529 plan. If you are using that super funding method, using more than 1 year of your annual exclusion amount, then you would need to file a gift tax return just to document your intention there. Let's talk about medical expenses. So in the case where you may pay medical expenses on behalf of the recipient, if those expenses are paid directly to the provider, a doctor, a hospital, even an insurance company, then that is not considered a gift. It doesn't count against your annual exclusion amount. It's not a gift. So another way to transfer additional dollars to someone outside the realm of the gifting rules that we've been talking about. And then likewise, if you make a tuition payment directly to a college or university, also not considered a gift, does not count against that annual exclusion amount. I think key here is tuition really does just mean tuition. So we're not talking about room and board. We're not talking about other expenses from the college or university, just the tuition payment. And with both of these, medical expenses and tuition, I do want to emphasize it must go directly from you as the donor to that medical provider or to that college. Even giving a check directly to the recipient, and then they turn around and take those dollars and give it to a hospital for a payment, or they give it to a college or university. Just the simple fact that the recipient has been the middleman, so to speak, in the scenario would not qualify under this. So you really do need to make sure those go directly to that institution or that provider. Well, we've gone through a lot of rules, a lot of tax law. So now we can talk about how these might show up in some real world case studies and some real world situations. So Elena, I'll let you go first and take our first case study here.
Great, thank you. You know, it's so funny that we are talking about this today because I literally had a friend of mine over the weekend asked me this question in case study number 1. His parents wanted to give him some money for a home purchase. And what's the best way to do this tax-wise? He wanted to know, don't people do this all the time? And I said, yes, yes, this is super common planning. We work with our clients daily on strategies like what you see here. So let's look at this scenario. Bob and Mary want to help their son, Tom, with a $50,000 down payment on a house. What are their options? So the first issue that I see here is that $50,000 exceeds the annual exclusion amount that Bob and Mary could gift to their son easily each year without using their lifetime exemption amount. So without going into that 13.99 million. The annual exclusion amount is 19,000, as we talked about. So they could easily give him $38,000, no questions asked, no tax filings, nothing. But what about the additional $12,000? Option A, gift him the $50,000 and file a 709 gift tax return, notifying the IRS that they've used $12,000 of their lifetime exemption. That is one option. It's a little bit more administratively burdensome because it involves an additional tax filing, which usually means additional CPA fees, but it's not the end of the world. Option B, this is a better option, but it requires some planning. If Tom needs this money in January for his home purchase, Bob and Mary could gift him the $38,000 in December. The taxable year resets in January, and they could make an additional gift of the $12,000 to him on January 1st. No tax forms required because these gifts were made in different years. Boom. A little bit of planning has gone a long way. So another thing to remember is that the $19,000 annual exclusion amount is per person, per donor, per recipient. Bob gives Tom $19,000. Mary gives Tom $19,000. That's how we got to $38,000. But remember though, if Tom was married, Bob could also give Tom's wife $19,000. Mary could give Tom's wife $19,000. Bob and Mary could collectively give Tom and his wife $76,000 in annual exclusion gifts without having to file that 709 and use their lifetime exemption amount. In that planning, it pays off.
Great points, Elena. And we are actually going to see Bob and Mary and Tom come back around here in a moment, I think. So let's move on to case study 2. I'll take this one. So in this situation, we have Sally, who is 84, and her daughter, Denise, 64. Denise lives with Sally in Sally's home, and Sally has owned this home for quite some time, 50 years. And as we often see over the course of time, has seen the value of that home increase pretty dramatically. So Sally's cost basis, what she paid for the home and the cost of renovations and upgrades and things over the course of time, makes her cost basis $200,000, but the value of the home today is $1 million. So Denise decides that she wants to give Sally her home. Sally decides she wants to give Denise her home because Denise plans to live there after Sally's passing. And Sally decides, for quote unquote estate simplification purposes, I'm going to go ahead and transfer the ownership of the home to Denise. So what unintended consequences may have occurred because of Sally's generosity? Well, first, as we talked about earlier, by making this gift, Sally has given Denise not just the home and the value of the home, but she has also given her cost basis in the home. So now Denise owns a $1 million home with a $200,000 cost basis. And we contrast this with if Sally had remained as owner of the home and then at her passing leaves the home to Denise, Denise would receive a step up in cost basis. So using these numbers, Denise would then have a $1 million home with a $1 million cost basis. Capital gains tax is really the impact here. So now let's assume that Sally has passed. Denise owns the home after Sally has given it to her. If Denise decides to sell the home, she is going to incur capital gains tax for the difference in the cost basis and the value, the difference between the $200,000 and the $1 million value. A small silver lining is that if this is Denise's primary home, which it looks like it would be, then she can exclude $250,000 of that $800,000 capital gain. But still, we're left with $550,000 in capital gain that she would need to report, which is not insignificant. And then last is gift tax consideration. So not to be lost in all of our capital gains discussion is Sally has used $1 million of her annual or of her lifetime gift exemption when she made the $1 million gift by virtue of the home to Denise, and she would need to file a gift tax return in order to report that.
Great. Thank you, Jonathan. So let's switch gears here a little and talk about when you want to do gifting to multiple people. And some insider knowledge here. Jonathan put all of these scenarios together, and I am loving the name Madge. Sounds like a boss. Anywho, Boss Madge and her husband Bill want to maximize their annual gifting to their 3 children. So 38,000 to each of them, 19 times 2. But we've got some family issues here. Their youngest child is on the verge of a divorce. To be cautious, they don't want to gift her the funds outright and risk losing them in the divorce. So what can they do? For the older children, no worries. Just transfer the cash or liquid assets directly to them. Just because you treat one child one way does not mean you have to do the same thing for all of them. For the youngest, though, soon to be divorcee, Madge and Bill should consider making this gift in trust. One or both of them should create a trust now during their lifetime called an inter vivos trust. You may have heard that term before. It just means during life. Create a trust for their child's benefit. If this is an irrevocable trust, meaning that Bob and Madge cannot just go and change the trust terms willy-nilly, any assets that they put into this trust should be protected from their child's impending divorce. Creating these trusts can get very complicated, as I've already talked about. So I want to reiterate that it is important to work with a qualified attorney, someone who specializes in this type of planning, so that nothing goes astray and there's no unexpected negative consequences of gifting to a trust. But trust me, if you are going to go down this path of lifetime gifting using trusts, you want things done well. It's worth the cost to work with a professional and to set up your team of guidance for your child and for yourself.
Thanks, Elena. Let's move on now to our 4th case study. And in this case, we have Ted and Susan, and they, like many individuals we talk to, want to help support the education costs of their grandchildren. And so they would like to give each of their grandchildren $100,000 this year. So with 4 grandchildren, that would be $400,000 total. And then they want to make future contributions of a smaller amount going forward. So we talked earlier about that special exemption that 529 plans have. What can Ted and Susan do in order to take advantage of that? So let's start with the current year gift. So Ted and Susan are each going to give, the way it would be interpreted is they are each giving $50,000 to each grandchild, $100,000 total between the two. So they each are giving $50,000. Using that 529 plan super funding approach we talked about, that $50,000 is assumed that is a gift of $10,000 per year over the next 5 years. So now Ted and Susan have each used $10,000 of their annual exclusion for the current year and then the following 4 years. Now, when we think about the coming years, what will happen is Ted and Susan now have some wiggle room, right? So they've only used a portion of their annual exclusion amount. Now they can give up to $9,000 in this current year because that would move them from the $10,000 up to the $19,000. So they have the ability to make an additional $9,000 gift even this year. And then as the annual exclusion amount may increase, so Elena addressed earlier how the amount has traditionally increased over the past 10 or 15 years. As the amount increases, they could also give an additional amount up to the current year annual exclusion in those future years. Some other considerations, good news with the new FAFSA rules around financial aid 529 plans that are owned by grandparents. And so a 529 plan could be owned by the parent of the child or by grandparents. Now 529 plans owned by grandparents are treated much more favorably when it comes to financial aid. So that's a good thing. And then as we're talking about using these annual gifts for future years, the donor does need to live until January 1st of that future year in order for the gift to be counted or for it to be assumed that you've used that gift amount for that year. All right, case study number 5. Elena, I think I've saved our stickiest situation for last. I mentioned that we would revisit Bob and Mary and Tom. And so in this case, Tom did accept and did receive the $50,000 gift. However, his house purchase has fallen through. And now with the $50,000, Tom made the decision that he was going to use this for another purpose. So he decided to use it partially to purchase a boat, but then also to make a contribution to a charity that he serves on the board of directors for, a sizable contribution. And so now Bob and Mary are not pleased. They did not intend that was the purpose of giving Tom the dollars. And so the question is, what could Bob and Mary possibly have done at the beginning in order to prevent this situation? So first, I mentioned the phrase earlier, attempting to over communicate. So it appears that when the gift was given, that possibly Bob and Mary did not clearly communicate to Tom the intention of the gift. They wanted Tom to use it for a house purchase and only a house purchase. And maybe that was not just the house that Tom was looking at or was possibly going to buy at the time, but maybe a future home. So being really, really clear in the beginning could have been very helpful. Second, maybe a story to go along with the gift, right? Maybe there was a reason that Bob and Mary wanted to make that gift to Tom. Maybe they had been helped in the past by a parent or family member to buy their first home. So possibly including a story like that as they made the gift would have helped solidify that in Tom's mind about the reason that they were making that gift to them. And then, right, some family, some relationship kind of issues to consider. How might this influence Bob and Mary's future giving? Hey, how might this influence Thanksgiving dinner, right? I mean, this is not an ideal situation. So I think that really goes back to the principle we talked about earlier of communication. You really can't over communicate these things when it comes to gifting. With dollars can also come complexity. So really clearly communicating on behalf, if you are the donor, what your intentions are. And then we don't want to ignore maybe what role Tom played in this scenario. I think any of us, it would be easy to say maybe Tom should have communicated better as well, reached out when the home purchase didn't happen and make sure with mom and dad that they were okay for him using that gift for another purpose. Elena, what do you think? Any insight or thoughts on this?
You know what I love about this scenario, Jonathan, is, this idea that your child received this gift and didn't do what they intended to do with it, what you intended them to do with it. And what I like about it is that this sort of gives you an indicator of what your child is likely to do with their inheritance. Think of this as sort of a test. But unlike an inheritance, you're around to see what happens. And you can then go and base your estate plan on what you've seen your child do with this sort of starter money, with this little test money. And it can give you some guidance on how you want to treat your child moving forward when they receive an even larger bulk, a larger distribution from their inheritance. So I think it's a very good idea, especially if you ever have any questions or, you suspect your child may not do what you would ideally intend them to do, is give them a little bit of money, see what happens. Do they do what you think they're going to do with it, or is it something else? And let that guide your decision making in your will or your revocable trust.
Great point, Elena. Great point. Just a little test case here, right? Before maybe more significant dollars are passed on in the future. Well,
Exactly.
we are close to out of time. So before we get to questions, I do want to remind you there is a link in the chat feature where you can click and schedule a 15-minute meeting. Maybe something that Elena and I have shared has sparked a question or an idea that you would like to discuss with someone here at Savant. Please click that link. That will lead you to where you can schedule that 15-minute phone call. We would enjoy talking with you and hopefully being able to help. So let's look and see what questions we have. I'm looking in our queue here. Elena, I'll take this first one. So someone is asking, if I want to gift shares of stock to my child, how would I do that? So assuming you were talking about the logistical aspect of doing that, then the first step in that process is your child, assuming the child is an adult, they would need to create an investment account. They would need to open that account at a custodian, maybe a Fidelity or a Charles Schwab, maybe use the same custodian where you are currently holding the stock now. Sometimes that can be an easier approach, but they would open that account. They would have their own account number, and then you would instruct your custodian where your account is, where the stock is located, to transfer or to journal those shares to your child's account. That may require a form, some type of authorization, but generally that can be done pretty quickly once you are ready to make the transfer within a few business days, and then that stock would show up in your child's account. Let's see what other questions we have. Elena, this looks like a good one for you. It says, I've heard there are unique circumstances for making a gift to a family member with special needs. Should I use a trust to do this?
Oh, Jonathan, you do like to give me the hard questions, don't you, sir?
Indeed.
So, gifting to family members with special needs is always something that needs to be handled with kid gloves, because the last thing that you would want would be for your gift to disrupt any sort of needs-based government assistance that your family member is receiving. So oftentimes a trust can be used. Usually it's the best vehicle for gifting to a special needs family member. But again, this is a very state specific, very, how do I put this? You need to make sure that it's done correctly. So if you have this sort of scenario where you're trying to gift to someone with special needs, I would directly consult that person or that person's caretaker. And then also, again, work with a qualified attorney to make sure there's no Medicaid, Medicare disruption, anything like that, that family member continues to receive those benefits. And with that, I think we are done for today. Thank you so much for joining me, Jonathan. I hope this has been very informational and beneficial to everyone listening.
If you enjoyed this webinar, visit savantwealth.com/guides and download our complimentary guidebooks, checklists, and other useful financial resources.